The world is a wild place, similar to a jungle where each individual struggles to survive. We are taught in school how to navigate this vast jungle full of traps. However, a significant problem arises when we realize that school does not provide us with the necessary tools to survive effectively in this environment. This leads to situations where we end up in debt with a fatal financial history, and each step forward becomes increasingly difficult. Therefore, there is no more valuable initial investment than betting on yourself. Reading and studying play a crucial role in surviving the financial jungle, and today, you will learn where and how to move your money. Money should never remain stagnant in the bank, as it loses its value over time. It is essential to move it strategically to preserve its purchasing power. However, it is crucial to note that managing this capital must be done cleverly. In investments, as you take on more risks, you may achieve higher returns, but the chances of recovering your investment also decrease. In the realm of investments, finances, and money management, there are two main possibilities for moving your money. You can choose to invest in fixed income, which implies that the invested money has a guaranteed defined return. In other words, you know exactly how much money you will earn. On the other hand, there is variable income, where there is no guarantee of a specified return. Neither of the two approaches is better or worse than the other. The decision goes hand in hand with how each person views investments and how much risk they are willing to take. For this, you need to decipher your investor profile. In summary, there are three investor profiles: conservative, moderate, and risky. If you are just starting in the world of finance, it is most advisable to start investing in fixed income investments, which are investments that already have a predetermined return, such as Treasury bills. Imagine you have a friend who needs money to buy a birthday gift. You lend him $50, and he promises to pay you back $55 in a week. That promise of returning more money in the future is similar to how a Treasury bill works. A Treasury bill is like a loan you give to the government of the United States. When you buy one, you are lending money to the government. In return, the government promises to pay you back the money on a future date with a little more. For example, you could buy a Treasury bill for $950. The government promises that, in a year, it will pay you back $1,000. That difference of $50 is your profit or return. Treasury bills are considered one of the safest investments in the world because, unless there is a government collapse, they are backed by the government of the United States. This is the most basic and secure investment you can make, and it is perfect for delving into the world of investment. One way these bonds can be purchased is through Treasury Direct. Speaking of secure investments and fixed income, putting your money in a savings account to have extra money for emergencies is one of the best things you can do. Imagine you have a piggy bank where you keep money. Every time you put money in, your piggy bank gives you a little more money as a gift. That is basically a savings account. A savings account is like a piggy bank given to you by a bank. You can put money in it whenever you want, and depending on the bank, you can also withdraw it when you need it. But unlike a normal piggy bank, the bank gives you a small gift in the form of interest for keeping your money with. For example, imagine you have $1,000 and you put it in your bank's savings account, and the bank offers you a 4% interest per year on your money. After a year, the bank will give you 4% of those $1,000. That's $40. The return on this investment is usually quite low, but with extremely low risk, and it remains one of the best options when you want to save money for emergency. It is important to choose a bank with the highest possible interest. Some good examples are SoFi Bank, Marcus from Goldman Sachs, or American Express. These investments are fixed income, and as mentioned earlier, profits are low, so it's time to delve into slightly riskier investments but with better returns, entering the world of variable income. In this type of investment, no predefined return is guaranteed. This is where the stock market comes into play, a market where companies offer small stakes of themselves known as stocks. To invest in the stock market and be able to buy these small stakes that companies offer, we need an intermediary, known as a broker. The strength of starting with stock investments is that it allows you to enter the world of variable income with relatively small amounts, helping you become familiar with variable income investment. Companies sell parts of themselves to the public to finance their expansion. When a company starts trading on the stock market, anyone can invest in it. Some examples of public companies include giants like Amazon, Apple, Facebook, and Samsung. With stocks, we can profit in two ways: through capital gains, buying at a low price and selling at a higher one, or through dividends, where the company distributes part of its earnings to investors. When choosing which stocks to invest in, there are two approaches: fundamental analysis and technical analysis. Fundamental analysis focuses on evaluating the financial performance of the company, considering aspects such as earnings, sales growth, cost efficiency, and competitive position. Meanwhile, technical analysis is like predicting the weather but for stocks. Past price movements are studied through charts to try to predict how they will behave in the future. That is, one decides what to buy, and the other determines when to do it. The problem with investing in stocks lies mainly in the risk they can vary depending on the decisions the company makes, so it is essential to analyze the company in which you want to invest thoroughly. Fortunately, we have the so-called index funds. Imagine you have a basket, and you want to fill it with different types of fruits from the market. But instead of going to each fruit stand and choosing each one, you decide to buy a pre-packaged basket that already has a mix of all the fruits sold in the market. That pre-packaged basket is like an index fund. An index fund is basically a basket of investments that tries to mimic a market index. An index is like a list of the best fruits or shares of companies. So, instead of choosing and buying individual shares of different companies, you buy an index fund that already has a mix of these shares. For example, if you buy an index fund that follows the S&P 500 index, you are buying a small part of the 500 largest companies in the United States. If the value of these companies rises overall, the value of your index fund will also rise. And if it falls, your index fund will also fall. The great thing about index funds is that they are an easy and low-cost way to invest in many companies at once. Instead of having to research, study, and buy shares of each company, you can buy an index fund and get broad diversification with a single purchase. Although index funds are exposed to the same market risk as individual stocks, diversifying the investment across many companies can help balance losses. Let's move on to a precious metal we all know. Investing in gold can be a good idea for several reasons. Firstly, gold can help diversify your investment portfolio. This means that if you have other investments that are decreasing in value, gold can help balance those losses. Additionally, gold is known as a safe haven, meaning it can maintain its value even when other types of investments are declining. This can be especially useful in times of economic uncertainty or financial crises. Some investors see gold as a protection against issues in the current monetary system. Additionally, gold is often considered a safe investment in times of geopolitical tensions. Finally, the supply of gold is limited and demand is growing, which could increase its value in the future. To avoid additional expenses when acquiring physical gold from a seller, an option is to invest in gold through a broker such as Robinhood if you are in the United States. This way, you can buy gold at its actual price without extra cost. Gold is an excellent metal for taking the first steps in the world of investments, but now, let's raise the risk a bit with real estate investment trusts. When you buy a REIT, you are buying a part of a group of real estate properties. It could be anything from office buildings and apartments to shopping malls and hotels. And the best part is that these REITs are bought and sold like stocks on the stock exchange. For example, suppose you buy a REIT that owns a series of shopping malls. Every time those shopping malls make money by renting space to stores, you get a share of that income. It's like owning a piece of those shopping malls. REITs are a good way to invest in real estate without having to buy a property yourself. They are ideal when you already have some understanding of investments and feel more comfortable investing. However, it's time to raise the level of risk even more and dive into blockchain technology. Making money through cryptocurrencies is one of the easiest ways to earn quite high amounts of money, but also one of the easiest ways to lose your money. Cryptocurrencies are not controlled by any government or bank. Instead, they are controlled by the people who use them. It is important to note that some cryptocurrencies are not backed by any project, so the price they have is the price given by the people who buy them. An example of a cryptocurrency backed by a project is Ethereum. Ethereum is an open-source blockchain platform that allows developers to build and deploy smart contracts. Its cryptocurrency, Ether, is used to power these applications. On the other hand, Dogecoin is an example of a cryptocurrency that is not backed by a specific project. It was created in 2013 as a joke based on a popular internet meme but gained popularity and became a legitimate cryptocurrency. Investing in cryptocurrencies carries a considerable risk, so it is crucial to conduct thorough research on the project backing the cryptocurrency. This includes examining the development team, understanding its purpose in the market, and assessing the reputation it has built up to the present date. All this information can be found in its white paper, which serves as a detailed instruction manual for the project. Given the significant associated risk, especially for those entering the world of investments, it is most prudent to invest relatively small amounts with funds that one would not mind losing. Additionally, it is recommended to diversify that small investment across various cryptocurrencies to substantially reduce the risk. After exploring various ways to manage our money, if you are a savvy person with skills to study the market, buying and selling products presents itself as an excellent investment option. Suppose you decide to start a t-shirt resale business. First, you identify a supplier that sells high-quality t-shirts at a low price. You buy 100 t-shirts at $5 each, totaling $500. Then, you decide to sell each t-shirt for $15. If you manage to sell all the t-shirts, you will earn $1,500. After subtracting your initial costs of $500, you would have a profit of $1,000. It seems easy, but it is important to navigate the market correctly with innovative ideas. If done correctly, this form of investment can provide one of the highest returns.